Almost everyone has at least one relationship with one financial institution. Practically all businesses, regardless of industry, require financial services at some point in time, be it credit cards, bank and time deposits, loans, insurance, or investments. But financials go beyond these. It evolves through technology, and rapid innovation has given birth to a long-term trend called fintech or financial technology. Fintech is a powerful trend. Electronic payments are steadily growing with a lot of room to grow exponentially. On top of this, we also have the rise of cryptocurrency and other blockchain technologies. With the ATRAM Global Financials Feeder Fund, investors can participate in growth of companies around the world that are involved with providing financial services. The fund gives you access and diversification to global financial names that we normally do not have locally. The fund also invests in fintech, which a normal financials fund would not. Invest in the biggest global companies in the financial industry. Participate in the global recovery. Diversify your investment portfolio by investing in this fund. Invest in the ATRAM Global Financials Feeder Fund. For more information, visit www.atram.com.ph.
The world around us is ever-changing. We are facing development challenges on a global scale. Today, 41 million out of 57 million deaths are attributable to non-communicable diseases. In the Philippines, 5 out of 10 families were deprived of basic education. The Philippines also ranked third in the top 10 countries with the most natural disasters. Women participation in the labor force is less than half at 48%, while male participation is at 77%. The United Nations identified and adopted 17 Sustainable Development Goals or SDGs to address the challenges faced by economies, societies, and the environment. We at ATRAM support the UN and the SDGs by launching the ATRAM Philippine Sustainable Development and Growth Fund. The fund is designed to invest in Philippine companies that score high in terms of the integration of UN SDGs into their operations and strategy. Through this fund, we hope to encourage PSC-listed companies to integrate UN SDGs into their businesses. We must work together to make a world a better place. ATRAM Philippine Sustainable Development and Growth Fund. Invest in a sustainable future together. Invest to thrive. Invest together. For more information, visit www.atram.com.ph.
Megatrends are shaping and influencing the global economy: urbanization, technological innovation, resource scarcity, and demographic and social change. The long-term shifts in these trends create multiple investment opportunities. They gave rise to a new type of investing called Thematic Investing. Enter the ATRAM Global Equity Opportunity Feeder Fund. The fund invests into the themes that would benefit the most today, making it the first global multi-thematic fund in the Philippine market. Unlike traditional investing, thematic investing is not constrained to sectors or locations, focusing instead on themes and megatrends. It distills the megatrends to find relevant topics that work in this current market environment. It finds the next big thing and invests in it at a very early stage. With this multi-theme fund, investors will have exposure to various companies that will drive future market growth. What's more, you can invest in all the new developments in this world in Philippine peso or US dollar, making it accessible to everyone. Invest in the fund that invests in the stories of tomorrow, today. Invest in the ATRAM Global Equity Opportunity Feeder Fund. For more information, visit www.atram.com.ph.
Good morning, everyone. Thank you again for joining us this week's episode of ATRAM Webinar Series. I am JP Chong, Business Development Manager, and I will be your host for today. The world is changing every day, and our investment strategies need to evolve to meet the challenges of a new world. Join us for our 2022 Market Outlook as we have invited ATRAM leaders and experts to share their insights on trends that will shape the market over the coming year, along with some of the attractive investment opportunities, and most importantly, how we can navigate a new world with confidence. If you have any questions, you may send them as early as now by clicking on the Q&A button below your screen. Before we begin, I'd like everyone to know that this session will be recorded and that the copies will be posted in all our social media platforms. Also, please do not forget to visit our website. That's www.atram.com.ph for a more detailed information about all the funds that we offer. If you have any friends who you think would like this webinar but are unable to attend, feel free to share the YouTube replay of this session and visit our YouTube channel. That's at ATRAM Studio. You may scan the QR code to visit our official social media pages. We'd like to invite you all to join ATRAM's official Viber community group. That's hashtag ATRAMPH community to stay updated on the latest announcements, advisories, and reminders. Scan the QR code or visit the link on your screen and get a chance to win ATRAM merchandise. We'd like this webinar to be as interactive as possible, so please do not hesitate to send in your questions in the Q&A tab all throughout the webinar. Each question you send is a raffle entry for a chance to win limited ATRAM merchandise. Winners will be announced at the end of the webinar, so make sure to stay until the very end. We'll also be wrapping up with a quick feedback survey after the webinar. We do hope that you can share your thoughts with us about our session for today and how we can further improve our webinar series. Out of the way, I would like to introduce our speakers for this morning. Here with us today are ATRAM's experts, headed by ATRAM Group's Chief Investment Officer, Mr. Phillip Hagedorn. Phil oversees the investments team, spanning the roles of portfolio managers, analysts, and dealers across different asset classes. Also joining us today is ATRAM's Head of Macro and Sustainability Research, Mr. Jose Marie Lacson. Jomar, as we call him, has over 20 years of research experience in equities, finance, and economics spent with various global and local institutional securities brokerage firms. And last, but definitely not the least, ATRAM's Sustainability Research Associate, Miguel Dela Cruz. Migs has previously worked as an associate and consultant in the business for sustainable development, working for various corporations on improving sustainability outcomes and operations. Good morning, Phil, Jomar, and Migs. How are you guys? It's been a while.
Hey, good morning, JP. Thank
Hi,
you.
everyone.
Thank you for the introduction.
Of course.
Jomar, Migs, good morning, you guys.
Nice to see you all again. It's been a while. I think the
Good
last
morning,
time I
Phil.
saw Phil in person was around December of 2021. It's been more than a month. Or was it November? And we had that webinar last week with Ernest Tu from Globe.
Yeah, that's right. So good webinar.
Yes. Also, Jomar, last time I saw it was around, and it was in the office when we went there around December, I think. That was a month ago.
Yeah, I mean, going back to the office was I guess a interesting experience. It's like just venturing out of your house is already you see the world in I guess even though it's the same world, it's called a new world at the same time. You know.
All right. I think
Well, it's good to be here today, guys. JP, I'm looking forward to sharing our view. I want to welcome all the participants today. Welcome to our first market strategy and outlook for 2022. Happy New Year to all. I know it's been a bit of a rough start to the year for many. But I think things are, from market's perspective, things are kind of starting off the way we thought they would. So at least from that point of view, we're quite happy. So JP, maybe we get going today with the presentations.
all right. So before we start with
We're going to be
this
doing things a little bit differently today.
Yeah. So of course we have limited time for this one, but before we start the webinar, Phil, Jomar, and Miguel, I'd like to address our audience for today. We have been listening to your comments, of course, and we'd like to allot more time for questions in today's session. Today's outlook is going to revolve around your burning questions. We'll do away with our usual webinar and we'll take a different approach for this time. I will go around and get questions from our audience in the Q&A tab and ask these questions to our speakers as we go along. So make sure to type in your questions in the Q&A tab found below your screen. So I guess I know just off the bat, I'll address this question to Phil, or anyone from the team can answer this one. So what are your thoughts on what's happening currently in the market? I know the markets have been rocky these past few weeks, and yesterday we recorded around 22,900 additional COVID-19 infections. I think it's a good way to start this webinar, and it's really great help for investors to know what's really happening and position their investments in the market.
Well, JP, I'll take your first question, and I think, as I said earlier, in terms of our expectations of how we were meant to start the year, I think markets, both globally and locally, are behaving as such. But maybe a good perspective is to take a look back at the last few years to see kind of the returns. Why we do a market update and outlook is not just to give you a sense of what the economy will do, but more important, I think, is to give you a sense of how we're going to manage our portfolios now, and what asset classes we think will do better than others this year, because as we know, no single asset class will constantly outperform others. No? And I think if you go to the next slide, that kind of shows you a picture of that. No? Just looking at this slide, and we've updated it to include already last year, 2021, no? Which just ended a few weeks ago. It's a very colorful slide, so we're waking everybody up early today. But these are the asset classes that basically we can invest in. And as you see, the returns every year are very different across the different asset classes. I want to point out one fantastic year. Let's look at maybe 2017. 2017 there, but not one single asset class that gave a negative return. Quite unusual, right? Quite unusual, but followed by 2018, those 2 years are prime examples of no one single asset class giving you a positive return either, right? So navigating this map, so to speak, as to what to put overweight and underweight in our portfolios is what we try to do. One highlight that I want to point out, and one area that maybe we can do a little bit of focus on, is Philippine Equities, because if you look at since 2018, you have these three. Actually, if you go back to 2016, really a poor performance for the last 4 years. Even if the Philippine equity space was the fourth best performing asset class in 2021, giving you still a negative return, by the way. We've had 4 years of really weak performance, and we feel this is an asset class to watch out for 2022. So just setting this up and setting the last year's performance, U.S. equities was the best performer, almost 3 years in a row, with big double-digit returns for U.S. equities. That's coming under a little bit of pressure now, and we're seeing
Right. Thank you very much.
We're seeing commodities and gold take a much higher level of performance in 2021.
All right. Thank you very much for that, Phil. And with that, I'll ask the first question. And I think this is one of the million peso questions out there. And we always get this question in all our webinars. So I think anyone from the team can answer. Yeah. So what is the best asset class to invest in? Is this a good time to invest? And how can I keep my investment properly balanced for the year 2022? Would diversification work for this year?
I'm gonna answer all those questions in the next few slides.
If
you go to the next slide, what we see. So what we see coming into 2022 is a general reduction in fiscal programs related to the pandemic. Handouts, in other words. We don't expect to see the handouts anymore. We do expect, though, that there will be more focus on medical support, on vaccinations, on testing as well, no? But less capital going towards just pure handouts. There was a lot of questions about credit quality during the pandemic, particularly in the Philippines. There was a fear of the non-performing loans to shoot through the roof. No? And as we improve and as we get a sense of where this is, doesn't seem to be as big a problem as was expected. And as we continue to open up, we don't expect the problem to get worse. We expect it to get actually better. But there will be a divergence of pace of growth and recovery across the globe, but generally on a path of growth and recovery across the globe in 2022. That's because the pandemic is transitioning into an endemic, which will allow economies to open up, governments to open up their economies, and treat COVID more from a support, medical support, vaccination support, testing support, rather than the policy of locking down economies. While these economies grow and start moving, inflation will be there, but I think you'll see it raise its head in different countries in different times. Last year, for example, Philippine inflation was well above our normal. We're going to end the year above 4% on average, while global inflation was much lower. This year, there's an expectation of global inflation to be rising higher, but I think inflation will go the other way. Will still be elevated. We're still looking above 3%, 3.5% on average, but better and an improving situation. You know, as we continue to grow, demand for energy is continuing to come back, and so we're seeing some pressure on oil price in the meantime. That's putting pressure on power and means that there's demand coming back. That's most important. And a lot of this talk about supply chain disruptions, I think that's going to be happening less and less. There'll be disruptions, but we expect it to be less of a theme in 2022 than it was how it was talked about in 2021. So this is kind of what we're seeing from a global perspective. Next slide just gives you some indications, no? And maybe I'll ask Jomar and Migs to give us their view. Jomar, what can you read into these slides, particularly in ASEAN? Because I think that's an area that has been neglected by investors, and we're seeing some flows towards ASEAN and EM. Can you just share your views on these slides, please?
Yeah, sure, Phil. So this basically are indicators for ASEAN and China. And like for exports, you can see that black line there is actually Indonesia. And I believe it's just being driven by its coal exports. As we all know, coal prices have been rising or surging primarily because of regulation on China's part. And that's why we're seeing this comeback. But overall, ASEAN exports, growth rather, from exports have been recovering. And this is really tied up to both the demand coming from China, and as we perform that sort of like support manufacturing infrastructure for China, but we are recovering. In terms of retail and recreation activity, remember this is a mobility sensitive sector. We've been trading behind. It's a lot to do with the vaccination. In the developed markets, which is the blue line, this is a middle chart. They've been already moving much faster than the developed markets or for ASEAN itself. Because they've managed to vaccinate a greater portion of their population, and more mobility has been allowed. but we're catching up. I guess that's the main point, that as we progress with our vaccination, we get to open up our economies, and we'll be catching up with the developed markets, or at least with the global markets. Manufacturing, which is the third to the last chart, has been above 50. So that means our manufacturing, despite after recovery, has been fairly stable. No? So I think overall the picture shows a recovery, maybe not as fast as the developed markets, but it is there. It is happening already.
Yeah, and
Great,
I think
Jomar.
just
Thank you. Oh, go ahead, JP.
Oh, sorry.
Miguel, that's you.
It's me.
Sorry, go ahead, Miguel.
Well, just to add to the swings for ASEAN in terms of retail and recreation activity. I mean, there have been lockdowns during 2021, and we haven't seen as big a swing downwards for the activity levels for retail. And could be partly attributable to a larger shift in adaptation towards, for example, using online channels to continue buying and selling activity for retail. So in general, there has been some resiliency despite the imposition of lockdowns for retail. But again, going back to what Jomar mentioned, we are lagging behind in vaccinations. So especially mobility sensitive consumption and retail has not been able to catch up at the same rate as in developed markets. But there is some
Right.
level of resiliency there.
All right. Thank you for that, of course, Jomar and Miguel. Just to ask one question actually, relative to your of course, details on our when we are lagging behind. In terms of the ASEAN markets, should we expect this bumpy cycle to extend to the first half of 2022, or just will it extend further for the year, or are we just eyeing this until, I don't know, around June, or could be further?
I guess that's the play for a global strategy. You know, Asia itself is still in a catch up phase, and it has a lot to do with the policies that we're putting in place. There are short-term policies, but are mainly on the health side, but there are also some structural policies that eventually will lead to a more stable recovery in the long run. One of them is recently approved RCEP. No? This actually stabilizes more on China's part, which allows sort of like foreign direct investments and trade flow between ASEAN and China, and of course the other countries in the Pacific area, to be more, I guess, more integrated. So in the structural sense, meaning long term, that should stabilize, like form new trading connections, which would be beneficial to us. But if you're just asking within the year, we're still probably going to see some bumpy rides, and each country is trying to tackle the situation with their own domestic policies. So we might see some imbalances, but the trajectory seems to be fairly clear. If you look at the charts, there is that recovery part. We'll probably have to decide on how to get there faster, but there are challenges to navigate. Yeah.
Anything to add, Phil?
No, thank you, Jomar. Thank you, JP.
Right.
Good question.
Yeah, of course.
Go ahead. Did you have something else?
Sure. Of course, moving away from the ASEAN sector, how about our friends from overseas, especially in the West End? Do you guys have any comments on the hawkish term, the current hawkish term of Powell and the Fed, which has been driving the global equity prices down? So this is more of a global aspect already.
Well, I mean, just looking at the U.S. first, I think the big concern there has been inflation, and as these supply chains ease up, then we can see it here very clearly. What's been the driver of inflation in the U.S., right? If you look at the colored bars on the right chart, I think it's very clear that the driver of inflation is the light blue and the gray. Those are new contributors, which were not there at the beginning of this period. No? That includes reopening scenarios. So a lot of that has to do with the supply chain issues. And the other one is energy, or the price of oil. No? These are, in my view, not going to last long. And so we would expect that the contribution to inflation from both the gray and the light blue start to ease off. and the Fed, I think looking at inflation and also seeing the growth of their economy will react to this, once things settle down. So we see inflation in the U.S. to be transitory and settling over the year. And I think at least our expectation is, it's very hard to read the Fed because they're keeping you on your toes, right, with their rhetoric. And they're managing this quite well because markets have adjusted higher in rates, which is, I think, what was anticipated. But my feeling is that a lot of this adjustment higher is going to happen in the first half of the year. So there will be an opportunity in fixed income this year, but maybe more towards the second half of the year. That's the view. So if you go to the next slide, and I'll just keep going here. What is our outlook and strategy? In the end of the day, we see the U.S. to continue to grow, although it won't be at the same GDP growth rate as in the past. And thus we'll maintain a significant weight in our global strategies to the US, but an underweight. We're overweight Europe. We think there's more value in Europe and easing supply bottlenecks to support that. And the rates coming back to a kind of more pre-pandemic level is what we expect. That was where economies were humming along at the more traditional growth clip. It's kind of where we're going back to, but we don't expect rates much higher than where we were back then, and I think we're nearing those levels already. So yes, there's room for rates to go up, but like I said, it's going to likely happen in the first rather than the second half of the year. It is an election year as well in the U.S. in particular. It's a midterm elections in November, so that's something to watch out for. In the meantime, in Asia, we're looking at China. China caused a lot of ruffles in the market last year, but things seem to be aligning themselves there and values emerging. So it's an area that we want to look at. And Asia and EM in particular, Asean, is starting to see some interest. So I think that's going to help. Bottom line for Philippine elections, to me, it's a positive for the country. So we can talk a little bit more about that in the next few slides, but I think we're
all right, Phil. Thank you very much.
About it.
Yeah, of course, we'll tackle more on the Philippine economy, especially the elections, later on today in our webinar. Before we proceed to the local aspect or the local markets, we have a very interesting question here. So before I ask that question, I would like to invite our audience to really key in your questions in our Q&A tab, and as we try to tackle each and every question as we go along. So for the question, anyone from the team can answer this. Based on the PE spread between the S&P 500 and the MSCI Emerging Markets Index, US stocks index, the US stocks are the most expensive relative to the emerging markets since at least around 2005. Do you expect this spread to remain further, or do you think there will be a switch out from the developed markets to the emerging markets? Is it just because of the China slowdown? Is the China slowdown a concern?
Well, I think, first of all, global investors, developed markets make up something like 70% of global indices. So you're never going to really switch all of that to emerging markets, right? In the end of the day, it's, I think the developed markets, particularly the US, need some consolidation. And while those markets consolidate, and some investors might take a neutral to an underweight position, what do they do with that excess cash and where do they put it, right? I firmly believe it's going to stay in the equity markets because fixed income, if rates are going to be moving up, very, very tricky to be redeploying to fixed income at the moment. And emerging markets offer value, and Asia offers value. The gap between our PEs, let's say even the Philippines, which has traditionally been closer to 20 times in the last 5 years, is at 16 times. We have a lot of room to make up. But we have to show that the earnings is going to come back. That's the proof in the pudding to attract the investors to come in, right? So if you look at our next slide, I'll just kind of show you where we favor. Clearly, on a global multi-asset strategy with a moderate approach, we still feel that almost 50% of your portfolio needs to be in equities. We have here 24% in Philippine equities, 21% in global equities. That represents an overweight versus what we would consider strategic positioning. We're maintaining the underweight in Philippine fixed income and global fixed income as we expect rates to move up. So this might change in mid-year. If rates move up significantly, we might start to add more weight to the fixed income. But for the meantime, we rather that the alternative space, which are alternative sources of income, is what's going to carry the return side or the yield side for us. But clearly, from this chart, the area that we're most bullish on, where we feel there's most upside this year, is Philippine equities. You'll see we have a 4% overweight versus a 0.5% overweight only for global equities. So, and maybe that's a good segue now, JP, into the Philippine story. Why are we so bullish Philippine equities? No? And I will ask Jomar and Miguel to kind of run through the economic outlook and forecast that we have for this year. And then I'll get into it when we talk about Philippine equities directly and the fixed income market. So Jomar and Miguel, please, the floor is all yours.
Okay, thanks, Phil. So this slide provides or reflects our view on how COVID is expected to pan out in 2022, 2023, which serves as the basis for our GDP forecast. So we believe the government needs to have a transition strategy from pandemic to endemic. Phil mentioned this earlier. But this also means instead of focusing on vaccines, we gradually shift to stocking up on medicines that increase the survivability from severe COVID-19, drugs such as remdesivir or molnupiravir. So to immunize the public, this will require sort of a combination or hybrid of both the vaccines and getting infected or reinfected, since at the end of the day, these approaches generate the production of the antibodies to defend against the virus. But the question we put is, when do you do that? Because it is a challenging policy question on the when part. So this table shows our view on what variables we're looking at and our own assumptions on the levels by which a shift in policy response would be triggered or conditioned upon. So you see healthcare capacity being our number one variable here. And we believe that if we can achieve below 10% for 3 consecutive months, that would be one of the factors behind a shift to that endemic policy. Vaccination rate, 100%. Currently, we're around 54, 55%. We're actually way behind our Asean neighbors there. But here, when we say 100%, we're actually talking about the hybrid version, meaning if we can get to the original 90% target fully vaccinated, the 10% is going to be, not everybody's going to be fully vaccinated, given the case in Europe and the US. But so how do we get to the 100%? So we define 100% here as being infected by much, I guess, less severe strain or less intense strain of the virus, and you recover. So you're now kind of like naturally vaccinated. But at the same time, our boosters are really low at this point. So if we achieve 30% boosters or a booster rate for vaccination, that's also one of the key variables that we're looking at as a combination. And lastly, the reproduction number, or the R0, as they would call it. It's kind of reflected of the positive rate that's reported in in media, but we believe that we need to at least have a reproduction number or a reproduction rate below 0.5 for 3 consecutive months to really bring that level downwards. Currently, we're doing just slightly less than 2. The numbers today are declining for NCR and I guess for the rest of the Philippines on a national number. So the response to move, that's the risk here really. I mean, the government, as we're transitioning to a new administration, they'll have to decide when do we shift to the endemic policy. Next slide will show you where we are right now. So if we were to look at the COVID bed capacity, you can see that there's this surge right now. We're close to about around 55% for NCR, 40% for the Philippines. That's a huge spike. We need to get to 10%. So that arrow there shows where we need to be for 3 months straight. Is our assumption. Vaccination, we're slightly improving. This is actually where we're behind. So we need to get to that over 1 million. At current pace, we're going to be fully vaccinated by April. So just need to speed that up. And positive rate, of course, I mentioned that we're already improving.
Right,
So this is the sort of like the summary of our assumptions that's driving our GDP assumption. So Biggs will be able to explain a bit the forecast.
Yeah, so connecting to our assumptions, so if you can go to the next slide. Connecting back to the assumptions for our COVID policy response at large, this sort of supports our expectation that momentum towards increasing mobility will continue. And then you add to that the consumption boost from the upcoming elections. This will support the more mobility sensitive consumer activities such as dining and transport. And this will ultimately lead consumption growth in 2022 as they recover to 2019 levels. So you see here that coming from around 50 to 70% of 2019 levels, 2022 will see that go. The momentum towards the recovery to 2019 levels will still continue despite some of the risks, especially, for example, through Omicron that we've seen in the past few weeks. And we're also confident that some fundamental indicators for spending power, such as employment, so we've managed to reach 6.5%, unemployment in November from around 7 to 8% in the past 3 months before that, and OFW remittances remaining quite robust. Those both support this consumption growth story in our view. If you go to the next slide though, there is some concern for lower private sector investment spending. If we illustrate that through construction, for example, so private sector construction since the beginning of the pandemic has been continually contracting. And using, for example, Megawide's order book as an illustration, the number of projects during the pandemic, 2020 and 9 months 2021 in this illustration, has largely remained stagnant. So this lack of new launches means that the recovery of expenditure for construction and in turn demand for durable equipment such as machinery will be delayed, but the new launches in 2022, hopefully, and later on, will hopefully kickstart this recovery of expenditure in the year after, so in 2023. You see here also the share of residential projects, which make up most private sector construction, has decreased significantly during the pandemic. Most of this investment spending has actually come from the public sector. And you'll see here in the rightmost slide that the budget for capital outlays, if you look at the government budget, has grown by double digits in 2020, 2021. And it still continued to increase in 2022, albeit at a slightly slower pace. So we can key in as well to government spending in the next slide, right? So this budget, more of this budget is actually being allocated to the local government units per the Mandanas ruling. This means that LGU specific mandates such as education and especially healthcare will be given more money to spend. And I guess this circles back to our earlier COVID policy endgame assumption and what Phil said relating to the focus being on being able to provide medicine, being able to provide vaccinations, being able to provide more testing. This budget, in our view, helps it propels sort of this activity it happening at a larger scale with more funding. And we think that this will largely be funded by borrowing, as you'll see in the rightmost slide. We will explain later what, when we talk prices, especially the implications of a higher debt to GDP level. We just wanted to highlight that we think the priorities of fiscal spending will be on a pro-expansion, pro-spending policy in 2022. And we can talk a little bit.
Miguel, I have a question on this then, right? Because
Sure,
a lot
Phil.
of folks are seeing that and maybe Jomar, you can pipe in as well. The debt to GDP ratio is now back close to 60%, which historically has been uncomfortable levels for the Philippines. Once you get to 60, 70%, that's not an area we want to be at, right? So the real challenge for the new government is going to be, how do they manage this situation? Because we need to grow out of this, so to speak, right? We need to generate the tax revenues, not borrow as much because we don't have that ability to do so based on these ratios. Or do we, right? Because if you look around the world today, 60% to GDP debt to GDP ratio is probably the norm. It's not, countries are above 100% in some cases. So what is it? What's going to be needed, I guess, to attract the FDI and to attract transactions to the market? Or are we already seeing any proof of that?
Well, on that, Phil, yeah, that's true. If you look historically, these levels for debt to GDP would start, raising concerns. But a major difference between Philippines today and Philippines when it was at 70% is actually we have over $107 billion in dollar reserves. That's fairly substantial. In the past, when we first had the crisis in 1990, we only had around 11 to $13 billion. So we're now over 10 times that, right? Or close to 10 times that. So that will provide some stability, but it also, just looking at the ratios, it just also says that the new administration must also be aware that that there are certain constraints to it. They have a good balance sheet to speak of, but as we borrow, we need to be borrowing for productivity. It has to enhance GDP.
So we shouldn't be afraid of debt, but just make sure that the debt that we use is productively, resourced and executed, I guess, right?
Correct. So like an unwise this policy would be to increase the bureaucracy, right? I mean, to just hire workers just to increase the levels of bureaucracy, which should have happened in the past. So that's not very productive, but investments in infrastructure, that's positive because there's a multiplier effect that's
right.
that enhances.
Okay, great. Thank you. Any other slides here, Jomar or Migs?
Well, just on our inflation forecast, right? I mean, maybe
GDP and inflation.
And maybe we could summarize quickly here. So looking at consumption driving 2022, we expect around 7.7% GDP growth. And then capital formation or investment spending catches up the year after, contributing to growth as consumption normalizes. So that's sort of that's how we summarize our views.
That was kind of the big surprise this year. Now, I think we thought that capital formation would drive more of the growth in 2021, and the consumer spending would take a bit of a backseat. And actually, the opposite happened, right?
Yeah, that was very clear, especially in the third quarter, right? If you recall.
What does that tell us? What does that tell us if consumer spending is back?
I think it's just basic. You can go ahead, Jomar. Or
no. One of our views there is adaptive expectations, meaning when consumers see, these are the constraints in the past, but I still need to consume. I have the spending power. I have income coming in. We can, or at least I can drive from savings. I will find a way. So we managed to
People find
navigate
a way
through
to
all of
spend at the end of the day.
right, and firms found a way also to reach the consumers through
Yeah.
online, through logistics, new supply chains were formed. This allows consumption to resume its path. If you look at mobility of groceries alone, very linear, very solid, like 60% explain that positive relationship.
So, Jomar, you
I
have a
guess-
pretty, among the market players, I think we have one of the more aggressive GDP forecasts for next year at 7.7%. Can you talk a bit about that?
Well, we're not too far, I'd say, from the consensus actually. If I'm not mistaken, us compared to consensus is only around 0.3% higher. Generally, on average, around 7.4, 7.5. So we're a little on the high end, but it's not too far off from what consensus says.
Got it.
All right. With that, everyone. I know we've been talking around about consumption lately. So, are we expect the Philippine economy to return to its growth trajectory in 2022 after nearly 2 years of dealing with the pandemic? Despite the threat of the Omicron variant, is consumption spending likely to discover this year for this one, or are we consider around the services sector? Of course, not to mention the upcoming government spending on this one.
Jomar,
Yeah.
I think you have some slides on that. No? Who's back and who's still short?
Right.
I don't know
So
if you've included that here.
maybe we can just go back 3 or 4 slides on the consumption. Can you go with more? Yeah. That's the
One
one.
more slide.
So you can see there that that table, those are the sectors: recreation, restaurants, transport, and alcoholic beverage that are still below their 2019 numbers. And that's really mobility sensitivity for you. It's recreation. If we have the restrictions, we cannot go out for concerts, restaurants as well, even though we've already increased mobility restrictions have been relaxed for restaurants. It's still not 100%. But the rest, the ones below, that's already either at the 2019 numbers or close to the 2019 GDP levels. So what does that tell us? Well, if we relax the mobility, the runway for consumption is going to be coming from the ones that are highlighted. This is our will snap back, so to speak, for consumption. So there is some upside from that, and we're trying to build that into our forecast for 2022 and 2023.
All right. Thanks for that, Jomar. So with that all said, referring this question again to everyone, what is your overall view on the Philippine economy? Is it stable or weak? And of course, with that, we want to keep touch base on the equity side as well. So
maybe let me answer that, JP. I mean, we think the foundation is very strong. So if you move forward, I mean, we're going to see a bit of inflation this year. We think it's going to be lower than it was last year. Our peso dollar rate, we expect the peso to depreciate. Right now, we have a level of 52 as the year end, but there could be factors mid-year if the economy really starts opening up much stronger than we think, that the peso dollar rate could actually weaken further beyond the 52 level. And I think that's where we're headed. I mean, just to give you a sense of the economy, in 2019, from a dollar perspective, let's look at it in dollar terms. We were at about 370 billion pesos in GDP. GDP, gawa dito sa Pilipinas, di ba? That's what the size of the economy was. That's 10 times more than it was in 1985, by the way, before the year the Marcoses left the country. Just to highlight, okay? It's a much different country than it was 30 years ago. And even in this pandemic, our contraction from a dollar point of view was not that big because our peso actually appreciated in 2020, if you recall. And I believe we're very close to the $370 billion GDP number even today. So don't think that the Philippine economy is, the headline says we're the worst, we're the worst. No, we've had a rough period, but by no means are we in any panic mode, so to speak, okay? The question now is moving forward. And it's all about the policy. It's all about opening up the economy and letting people get back to work and making sure we can manage the health crisis at the same time. That is the secret sauce. There's no secret to it, but that's the secret sauce.
All right.
And
Thank you very much for that, Phil. Again, you've mentioned the Philippine equities or the economy. So we all know that the PSEI closed yesterday at around 7,200 levels. That's way, way better during the height of the pandemic. Will this trend continue as we move forward? And of course,
Well, we think
given
so.
the current market situation,
Yeah, we
the
think so.
criteria for the equity selection for 2022? Inserting one of the questions from our audience, should we invest more in the local or global stocks? Any thoughts on this one, Phil?
Well, like I said, I mean, we're obviously bullish both global and local, but I think the local market will outperform the S&P in this year. I mean, that's not a difficult bet to make because the S&P has returned super returns for the last 3 years. If you're going to have 1 year where it has some consolidation and our market sees, what we expect is this, and this is what we expected this year as well, right? We said this year 7,500 was a target. Sorry, in 2021. We got to 7,400, 7,450 in November, and then we had the pullback because of this Omicron. We're at 72, 7,300 today, in the ballpark of where we felt we should be by the end of the year. By the end of 2022, we think because of earnings recoveries across many sectors, we expect the market to be somewhere in the mid 8,000 level, 8.5, 8.6, purely on the back of a recovery in earnings. This has nothing to do with elections. This is a target based on fundamental analysis of earnings and what the PE multiple could be. Of course, there's upside to that and there's downside to that. But our current view is 8,600 is the target for this year. And from where we are today, that's a pretty significant upside that we have. And that's kind of the story. I mean, of course, it's going to be earnings driven. And as we all know in this country, property sector, the banks, and the conglomerates that own the property companies and the banks are the ones that are going to deliver these earnings at the moment. And the high risk, I believe, for the delivery of earnings is in the property sector because there's an expectation of recovery. There's an expectation of the malls coming back this year, right? And so far, that's been put on hold. But as we saw in the fourth quarter, how quickly mobility can come back, if it's a couple of weeks delay, that's not going to change the outlook for the year. So we have to see that we manage this Omicron over the next few weeks. And hopefully by the end of February, we're back to where we were in November in terms of the opening ups. And that's going to bode well for markets and sentiment. So in short, that's the view, JP. The next slide, we're going to look for, we're not making much changes to our portfolios. We've kept our eyes focused on looking for value, high quality companies, those that are looking to start to spend. We want to see the CAPEX cycle start to begin again. Once you start CAPEX, investors start to believe that the earnings over the next 2-3 years could grow. If you don't spend, it's very hard to imagine that your earnings are going to grow in a big way. So these are things that we want to look at, and companies that we're investing in want to be in this part of the cycle for their own segments and sectors. Next slide, please. Touching on Philippine fixed income, like we think rates are going to be moving up. You want to play it conservatively at the moment. You want to stay in the short end of the curve, even if the yield is very low. And there could be opportunities sooner rather than later if rates move up the way we expect in this first quarter. So if you look at our positioning in the next slide, and I'm sorry I'm rushing through this because I'm running out of time, but our positioning is we put our money where our mouth is, and you'll see that our positioning in total return strategy is very short-term oriented, nothing over 5 years or 7 years, I think, on our next slide there. And so that's the way we want to play the Philippine fixed income market at the moment. You want to stay conservative and liquid, and maybe when rates move up, you'll have that opportunity to go and stretch duration out to a further period. No.
All right.
So JP, I'm
course,
gonna end
I
I believe
of course.
I ended here today.
Yes, of course. Yes, Phil. Thank you very much for all those. But before we recap everything, to wrap everything up, there's a very good question here from our audience that I would like everyone in the panel to tackle on. Just this last question. I know we are pressed for time. So this is really one of the hottest questions out there. So elections are coming this May, and the much-awaited presidential debates are just right around the corner. So how do you guys see the elections panning out this year? How would it affect our of course, our economy moving forward, not only for 2022?
Well, I mean, our elections traditionally are very good for markets. Okay, elections are good for markets because people get a sense of a new leadership and new direction, and normally nobody tells you I'm going to take you down the wrong road, right? Everyone paints a very good picture of what their leadership could bring. And I think that's what we, looking at the candidates today, I think we haven't heard much from some of them, more from some than others. And I look forward to these debates to begin so that we get a better sense of what their philosophies and views are, especially in light of this GDP to debt to GDP ratio we're in. So what's their attitude towards debt? How do they expect to grow the economy? And probably the most important question that people are asking is jobs. How are you going to create jobs? When you look at surveys out there for what worries the Filipino, it's jobs. COVID is number 8 on the list of what worries Filipinos today. So there are other more pressing concerns that are out there, and these candidates need to address that, right? Personally, I don't think there's any candidate that would be anti-market. I don't think the market, any candidate there has shown that they would be, left-leaning or socialist or any of that. I think we're all talking to central right capitalist type leaders. Foreign investors are certainly interested. So it's going to be critical that the messaging that comes out of these candidates in the next few months are heard, and they're able to share that, because if there is ambiguity, if there is uncertainty, that's what's going to scare markets. One example is if you have a leader that's leading and that chooses not to talk all the way until election day. I think that will be a bit of a rougher pill to swallow than views and opinions being out in the open. So overall, I think it's positive, but I do wait to hear about what policies these leading candidates have to give my final verdict.
All right. Thank you very much for that, Phil. So once again, thank you very much, Phil, Jomar, and Migs. Of course, any last words to wrap it all up? I know it was really a lot to soak everything up, and we still have a few minutes. So just a quick recap. More of a final words for everybody who is attending our webinar as of the moment. Just a quick recap on ATRAM's market stance for 2022, and as we formally close this webinar.
Yeah, so starting off with, the major concerns and what's been the headlines. It's how growth is going to go, developed market, emerging markets, and the Philippines. Are we going to continue on this growth path? Will we be able to manage inflation while we're growing as well? We have a very low yield environment at the moment, and we expect volatility. So we need to manage that. And the view there is to be more optimistic on growth markets and equities at the moment, despite this Omicron surge, with recovery as the central theme, and consumption-led growth, particularly for the Philippines and emerging markets as well. From the global standpoint, we're still heavily weight in North America. Probably over 50% of our selection is weight in North America, but that's underweight. And we favor today Europe and Asia. And from a sectoral point of view, we'll favor the financials and commodities in the global space. We remain underweight both global fixed income and Philippine fixed income. We suggest you stay nimble, you stay at the short end of the curve, and take advantage of opportunities as rates move up. On the Philippine equity side, we're favoring large caps and some selected small caps, particularly in the consumer sector, because as we said earlier, we think it's still a consumer-led growth story for the Philippines. And so our overweights in our small mid-cap range are going to be concentrated more in the consumer sector. And don't forget alternatives. It's a very important part of everybody's portfolio. They include things like REITs, hedge funds, private investments, and provide a safety yield and a higher yield than what fixed income would do at the moment. And I think it's an important part of everyone's portfolio to be able to balance that underweight in the fixed income markets that we're recommending at the moment.
All right. Thank you very much for that, Phil. And of course, thank you very much, Migs and Jomar. With that, everyone, that brings us to the end of our panel discussion for today. I'd like to thank you all for your time and attention. So our mission to provide you all, our clients, effective investment solutions. We hope that we were able to address your concerns as we take on this new year and be able to look at this as another opportunity to position our investments for the long-term growth. All right. So ATRAM has a wide range of investment products, and our capabilities span across several asset classes, meant to service the different investment objectives of each individual. And with these, it is with great pride that we announce that ATRAM has recently achieved 9 industry awards for 2021. To start it off, the best local fund house in the Philippines, given by Asian Investor, the fastest growing fund management company in the Philippines, given by the Global Banking and Finance Awards, and by the Global Economic Awards, the most innovative mutual fund offerings, again by the Global Economic Awards, the best investment solution provider from World Business Outlook, and the most innovative asset management company from Pan Finance Awards. We'd also like to add that ATRAM Group and ATRAM Wealth received the editor's triple star from the Asset AAA Sustainable Investing Awards and the Asset AAA Private Capital Awards, respectively, for integrating ESG, that's environmental, social, and corporate governance, in our investment process. Finally, we want to say that the ATRAM Total Return Peso Bond Fund has been recognized by the CFA Society of the Philippines as the best managed fund of the year for Peso Medium Term FVPL valuation category. For today's session, we hope to have somehow assisted you all to hashtag Take On Tomorrow by investing your hard-earned money with an award-winning fund house. Once again, thank you very much, Phil, Jomar, and Migs. And of course, thank you to our audience. We appreciate you taking the time to join us today. We hope you were able to gain insights and key takeaways from today's interactive webinar. Now, did you know for as low as 1,000 pesos, you can already jumpstart your investment journey? Here's how you can invest on ATRAM funds.
Hello. To open an account with ATRAM, just visit our website at www.atram.com.ph. Here, you can learn more about all the funds and services that we offer. Our site will then guide you to our online investment platform, Seedbox, where you can start investing for just 1,000 pesos. But if you have more questions, visit the website's Frequently Asked Questions page or ATRAM Academy page. Thank you.
In celebration of the upcoming Chinese New Year, we have invited Feng Shui Master Patrick Ray Lim Fernandez of the Yin and Yang Shop of Harmony to give us investors useful tips that may help us live a more prosperous life. Join us in this once-in-a-year opportunity for enlightenment and expert guidance. You may do so by scanning the QR code, or you may also type in the link flashed on your screen. Again, if you have any friends who you think would like this webinar but are unable to attend, feel free to share the YouTube replay of this session and visit our YouTube channel that's at ATRAM Studio. You may scan the QR code to visit our official social media pages. We'd like to invite you all to join ATRAM's official Viber community group. That's hashtag ATRAMPH community to stay updated on the latest announcements, advisories, and reminders. Scan the QR code or visit the link on your screen and get a chance to win ATRAM merchandise. Lastly, please answer the survey at the end of this webinar. We'd love to know your thoughts on today's topic, of course, and on how we can improve moving forward. On behalf of everyone here at ATRAM, thank you very much again for your attendance and participation. We wish you and your loved ones continued health and safety. Have a great day, everyone.